Welcome to our reading on financial analysis techniques. Now really what we're talking about here is ratio analysis, and it's going to be absolutely critical to master your ratios for success in the CFA exams. You've got to remember the purpose of all this financial statement analysis is that we're an analyst and we want to compare the performance between companies, maybe for valuation or credit analysis. The purpose is not to convert us into some form of bookkeeper. So always when we're looking at the changes in accounting policies, we're likely to see questions asking us how the ratios are affected by adopting different accounting policies. So a real critical area to make sure you're on top of for the exam. Now our first LOS asks us to describe the tools and techniques, uses and limitations of our ratio analysis. We've already broadly touched on these. Cross-sectional analysis means comparing between companies at a fixed point in time. So it could be comparing between competitors. It could be comparing our company to industry averages or industry norms. Time series typically means looking at one company over a period of time and maybe looking at how their ratios are changing. So it's trying to pick up on trends in ratios. Now ratios themselves don't actually answer any questions. What they really do is they provide the analysts with the questions they need to ask the firm's management team. So let's look at our vertical size, common size statements. Again, we've touched on these in earlier readings. So if we're going to provide or produce a common size statement, remember what we're really doing is we're converting absolute data, i.e. figures that are in monetary values, into relative data so we can compare firms of differing sizes and so we can make comparisons across time. So in the income statement, we do this by looking at each income statement balance line by line as a percentage of sales. Obviously, sales would be 100% in this case. In the balance sheet, we do the same thing, but typically we look at each item as a percentage of total assets rather than sales. Now we've looked at vertical common size statements, but we haven't touched on horizontal common size statements before. Here, each item is given a balance of 1 in a base year. What we're then doing is looking at how they change over time. So let's take our cash for example. So notice in year 0, our base year, it's given an index value of 1. Then in year 1, notice it's given a value of 1.2. Well, essentially we can therefore tell that cash is 20% higher than it was in the base year. In year 2, notice it's 1.1. So in year 2, cash is only 10% higher than the base year. Graphs, well, yeah, graphs, nice visual indication of what's happening, allowing us to analyse maybe performance or financial structure. So we've got various types that we need to be aware of. Pie graph, stacked column graphs and line graphs. Let's imagine a pie graph looking at total assets. So of course a pie graph, nice circle, or that's meant to be my circle anyway. So let's imagine that PP&E, our tangible fixed assets, are 50% of total assets. So there they go. So this would be our P, P and E. Let's imagine intangibles are about 20%. So there we go, there's our intangibles. Maybe inventory is another 20 or 25%. Maybe cash is 30%. And maybe accounts receivable, the balance. So the idea with a pie chart is, of course, we can instantly see a visual representation of how each asset is a percentage of total assets. So it's a nice visual composition of total value. Now a stacked column graph does this, but also allows us to analyse changes over time, and we're going to see that on the next slide. So here's our stacked column graph. You can see we're looking at data here from 20x4 up until 20x8, and we're seeing essentially the changes in items over time. So you can see the trade payables are the biggest percentage for this particular company, and you can see how they're changing over time. You can see very clearly that the company didn't have any lease obligations in X4 or X5, but they started in X6, and you can see that they've grown and increased up until X8. You can see how cash has changed. You can see how cash is varied over time and actually dropped slightly into X8. So a nice visual representation how composition is changing over time. Now again, what we could do is we could look at that data as a line graph. Now again, here with our line graph, you can see the lease obligations. You can see there's nothing in X4 and X5, and you can see that increase starting in X6 and increasing X7 and X8. We can look at the trade payables. You can see the trade payables amounts have increased, and you can actually start to see the size of the increase or the speed of the increase. So we can see that it's stepped up because the angle of our line is increased in X7 and X8. And you can see the cash slowly declining each time. So a nice visual representation of what's going on in the company. Now we're asked as well, of course, to be able to discuss the limitations of our analysis as well, in particular with financial statement ratios. First kind of point, and it's a key one, they don't tell us much in isolation. We need some form of benchmark to compare our ratio against. Does it look good? Does it look bad? So, of course, that allows us to use maybe cross-sectional analysis. Let's compare the ratio of our company with the ratio of competitors or industry norms. Now, we've got to be careful in that scenario. If we are comparing ratios between companies, we need to make sure that they've adopted similar accounting principles when preparing their accounts. And you can see that's actually our second point there. So very critical with cross-sectional analysis. But of course, not just using cross-sectional analysis, we can also use trend analysis as our benchmarks to see how a company's ratios have increased and decreased over time. So yeah, so certainly cross-sectional, but also historical performance trend analysis. Now, different accounting treatments in particular are maybe a problem for cross-sectional analysis, and when we look at international cross-sectional analysis, i.e. comparing firms in different countries, then of course the problems become even greater, because of course maybe looking at IFRS-based firms versus US GAAP firms, there's going to be differences in those accounting standards and therefore how the accounts are being produced. Now, next one is finding comparable industry ratios for companies that operate in multiple industries. So what we're looking at here is a conglomerate. So an idea that it has lots of different, often very, very different business operations. Now our problem is the income statement, the balance sheet, the cash flow statement are combined. They're for all of the various business operations. What that means is it's going to be very, very difficult to find similar companies to benchmark against. Now, it's not a disaster because we do have segmental analysis in a set of accounts that allows us to look at ratios maybe on a divisional basis rather than a group basis. So with conglomerates, trying to actually compare ratios based on the consolidated income statement, consolidated balance sheet, or consolidated cash flow would be very, very difficult. We would need to find competitors that have not only the same business activities, but they'd need to be in the same proportions as the company we're comparing. Therefore, the segmental analysis is going to be absolutely key when we start to look at conglomerate industries. Now, all ratios must be viewed relative to one another. In other words, you can't view a ratio in isolation. If one ratio is going up, one ratio might be going down. What is that telling you about the big picture? Now we're going to see looking at ratios in relation to one another when we start to look at DuPont analysis in particular a little later. Now as well, what is a good ratio? What is a bad ratio? Well, we've said we can use industry benchmarks, but again, there's going to be a degree of subjectivity, especially if we're coming up with a range of acceptable values in which we want our ratios to fall. Now, common size income statements, we've really described these already. We've talked about every item in the income statement being shown as a percentage of sales. By doing that, we convert the absolute data from the income statement into relative percentage terms, and as a result, we can compare firms of very differing sizes. But also it allows us to analyze changes in cost structure. In particular, what do we mean by cost structure? Often it's the blend of fixed versus variable costs. Now, if you've got a high fixed cost business, as sales volumes increase, costs won't. So you'd expect things like your profit margins and therefore your common size income statement percentages often to change as a result of that. If you've got a variable cost business, of course, then the cost will rise in line with increased revenues and therefore the percentages will remain relatively constant over time. Now, as we said, we can use it cross-sectionally, common size, comparing firms. And the beauty is, of course, it doesn't matter if the firms are of the same size when we use relative terms. But we can also use it to look at how a particular firm's balances have changed over time. So time series analysis. So let's have a little look at our example here. We've got a common size income statement. We've got a bit of information about the income statement here. We can see that cost of goods sold was 58% of sales in 20x7, 62% of sales compared to an industry average of 60% of sales. So we can see that our cost of goods sold was lower than the industry average, but in X8 it's now higher. Sales, general and admin, again, has gone from a value that's very close to the industry average, 18% of sales, up to 22% of sales. And at the same time, we can see that our net income, now of course, net income divided by sales is actually the net profit margin. So when we look at the 9 and 8%, we can see that our net profit margin has fallen from 9% down to 8% compared to an industry average of 10. What does this tell us? Well, in particular, we can see that our cost base for this company is increasing, at the same time profitability is decreasing. So look, an increase in cost of goods sold as a percentage of sales is going to tell us really one of two things. Either our sales prices are lower, so the sales revenue is lower as a percentage of cost of goods sold, or alternatively, we're incurring more cost, materials cost, labor cost, the cost of manufacture has increased. Increased sales, general and admin also suggests either lower selling prices, and hence sales revenue is lower as a percentage of sales, general and admin, or alternatively higher costs. And then finally our profit margins, well again, either that's saying to us, because our profit margins have dropped, either we're selling at a lower price or our cost base has increased. Our next learning outcome asks us to classify, calculate and interpret categories of ratios. So let's have a look at our various categories. First of all, activity-based ratios. Now notice these are efficiency ratios, how efficiently the company is operating. Liquidity ratios, that's looking at the company's ability to pay off short-term liabilities when they fall due. Solvency is really looking at the capital structure, the debt to equity, and therefore the ability to pay down debt when it falls due, the ability to meet your long-term debt obligations. Profitability is again looking back at performance, and it's looking at how well we convert our sales into actual earnings. So the ability to convert sales into earnings, but also as well the ability to generate sales from our asset base. And then finally, valuation-based ratios are the ratios that we're going to use in our valuation analysis. It could therefore be used for financial modeling in order to generate cash flows to build into maybe a free cash flow model to value a company's equity, for example. Ratio analysis context. Well, when we're looking at our ratios, we do need to hold them in context with what the company's goals and strategy is. In other words, let's look at the management discussion and analysis, let's discuss with the management team themselves, and then let's have a look at the ratios to see if they're consistent with what we're being told. Now, ratios, of course, may be industry specific, which is why it's often useful to compare to industry competitor or industry norms. As we mentioned before, multiple lines of business are going to distort aggregate ratios. In other words, remember, the income statement, the balance sheet, cash flow statement is for the entire group, all of its multiple lines of business condensed into those financial statements. In other words, we're seeing lots of business activities combined here, and therefore it's very, very difficult to find meaningful benchmarks. But remember, we do have a solution, or at least partly a solution. We can start using our segmental analysis, which we'll discuss later. And of course, we've also talked about the idea that different accounting methods, different accounting principles chosen between firms is going to reduce our comparability. Now as well, not only do we need to think about the industry when we're analysing ratios, but we need to think about the economic cycle, the business cycle, the current stage of the business cycle, and the likely impact that that's going to have on a company's ratios. So for example, for a fixed cost business, as we hit maybe a recession, you'd expect sales volumes to fall, fixed costs to remain high, so therefore you'd expect your ratios to be changing. So we do need to think about how the cyclicality of the business cycle affects the ratios and our expectations of the amounts that we're going to calculate. Now, this is really talking about pure and mixed ratios. A pure ratio is one that takes both the numerator and denominator from the income statement or the numerator and denominator from the balance sheet. Okay, now because the income statement is a dynamic statement and spans a period of time, as long as both the numerator and denominator of the ratio both come from the income statement, that doesn't cause us a problem. Likewise with the balance sheet. Now balance sheet values are at a fixed point in time, the year-end date of the company. So again, as long as both numerator and denominator come from the balance sheet, we don't have a problem. But what happens when we're looking at mixed ratios? So a mixed ratio simply means maybe the numerator is from the income statement, the denominator from the balance sheet, or vice versa. Now here, potentially we have a problem because the income statement item is dynamic. It's been developed, or if you like, compiled over an entire year, the period between two balance sheet dates. But the balance sheet item is a snapshot at the year-end date. So maybe we pick up distortions. In that situation, because the income statement's dynamic, but the balance sheet static, then the solution is to use average values for the balance sheet item. So when you're looking at mixed ratios, if you've got the data to do it, take the income statement item and compare it to the average balance sheet item. Now what is the average balance sheet item? Simply last year's balance sheet value plus this year's balance sheet value divided by 2. So let's start off with our first classification of ratios, and we're looking at our activity-based ratios, talking about the operational efficiency of our company. Now the first ratio we have here is our inventory turnover. Inventory turnover, you can broadly think about it as how many times the inventory levels are used, or how many times the inventory is completely used up and needs to be reordered during a year. Now you can see we're going to calculate it as cost of goods sold divided by average inventory. Why? Cost of goods sold from the income statement, ending inventory of course comes from the balance sheet, so we're looking at a mixed ratio here. Now, inventory turnover, a little tricky to interpret. As I said, you can think of it broadly as how many times you need to reorder goods during the year. But it's more useful to turn it into days of inventory on hand, DOH as we often call it. So all we need to do to calculate that is take 365, the number of days in a year of course, and divide it by our inventory turnover. This tells us the length of time between receiving raw materials and selling our finished goods. So in other words, it's the raw material holding period, it's the production period, and it's the finished good holding period all combined. Length of time between receiving raw materials and selling finished goods. Now in practice, each of those elements, the raw material holding period, the production period, and the finished good holding period can actually be separated out, but there's no requirement to do that in our syllabus. Be aware that you're going to be very likely to be asked to calculate both ratios in your examination. Very common ratios, must be able to calculate them. Our receivables turnover. Now receivables turnover, it's our accounts receivable, our trade receivables over average receivables. It's another mixed ratio. So revenue on our numerator, now revenue of course comes from the income statement, it's dynamic, but on our denominator we've got average accounts receivable, or average trade receivables, which of course is from the balance sheet. Now it's very difficult just to look at receivables turnover and interpret it. I guess you could say it's the number of times your customers fully pay off their balances in a year, but that's a little bit of a dubious definition. What's much better is to turn it into days of sales outstanding. So if we take 365 and divide by our receivables turnover, now what we've got is the length of time between selling a good and collecting the cash from the customer. In other words, the credit collection period for the customer. And hopefully, of course, this stacks up to the credit terms that it's offering customers. Payables turnover. Now notice on our numerator for payables turnover, we've got purchases. Remember your cost of goods sold, beginning inventory, plus your purchases, less your ending inventory. And that gives us, of course, our cost of goods sold. In other words, you might have to do some work here to calculate purchases. If you've got essentially only cost of goods sold, then you're going to need to essentially look at the beginning inventory and ending inventory that you're going to find in the balance sheet to isolate the purchase figure. So purchases, it is essentially in the income statement within that cost of goods sold figure, so it's deemed to be an income statement item. Trade payables, of course, or accounts payable as we often call them, are a balance sheet item. So again, yet another mixed ratio with these activity-based ratios. Again, trying to interpret payables turnover, I guess you could say it's the number of times you pay your suppliers in a period, but it's going to be much, much easier to interpret it as number of days payables. So here what we do is we take 365 and divide it by our payables turnover. What is this telling us? Well, it's the length of time between receiving materials from our suppliers and actually paying them. Working capital turnover, I have to say I'm a little less excited by this. First of all, let's start with our definition of working capital. Now, definition of working capital here is simply current assets minus current liabilities. Okay, so we're looking at our sales divided by the average working capital during the year. Again, the revenue, the sales figure coming from the income statement, working capital is our current assets and current liabilities, hence a balance sheet item. How do we interpret it? Well, you can think of this as being efficiency. How efficient are we at using our working capital to generate sales? So basically, the higher the figure, the better in this case. Now, fixed asset turnover, sales over average net fixed assets. And when we use this phrase net, all we mean is the gross cost of the fixed assets less their accumulated depreciation. So in other words, carrying value. So we're looking at revenue over fixed assets. Now remember, our fixed assets, our PP&E for example, is our infrastructure out of which the firm operates. So fixed asset turnover is looking at how efficiently we use our infrastructure to generate sales. Again, the higher the ratio, the better. Total asset turnover, well, essentially all we're doing, rather than just looking at fixed assets, we're looking at the total asset base of the company. So it's fixed assets, it's infrastructure, plus its working capital, and looking essentially at how it uses it to generate sales. Again, logic being higher figure is better. So let's turn our attention now to liquidity ratios. So these are all about essentially meeting our current liabilities as they fall due. Now, the most famous of probably our liquidity ratios is the current ratio that looks at current assets divided by current liabilities. Notice that this ratio is a pure ratio. In other words, both numerator and denominator in this case have come from the balance sheet. As a result, we can use ending figures rather than average figures. So current assets divided by current liabilities. Now, a very basic rule of thumb is if the current assets were lower than the current liabilities, it could be an indication of a liquidity problem. In other words, you've got insufficient current assets to pay off your current liabilities. Now, that is a bit of a simplification because actually we also need to consider how fast the current assets are turning over relative to the current liabilities. In other words, a company could have a current ratio that is less than 1 but not have any liquidity issues. Supermarkets being a classic example. They have very few current assets. Inventory is relatively low. They don't have trade receivables because people pay in cash. So they have relatively low current assets. Now, in that scenario, what we actually tend to find is the current assets turn over very, very rapidly relative to the current liabilities. Now, what that is essentially telling us is just looking at the current ratio alone is not enough. What we need to do is look at that current ratio in conjunction with the cash operating cycle, and we're going to cover that a little later. Quick ratio just essentially removes the most illiquid current asset that we have, and that's inventory. So it's pretty much looking at all of our assets, all of our current assets, I should say, excluding inventory. The reason inventory is considered illiquid, let's imagine you've got raw materials. You've got a pile of raw materials. First of all, we've got to manufacture the good, then you've got to sell the good, then you've got to collect the cash from the customer. In other words, there's a long lag potentially between having the inventory and converting into cash. It's a pretty illiquid asset potentially. So all the quick ratio is doing is recomputing the current ratio, removing this illiquid current asset. Now, the cash ratio itself goes for the most liquid approach to liquidity. It looks only at the assets that are either cash or can be converted into cash very, very quickly. And of course, the assets that we can convert into cash very quickly are our marketable securities. Securities that are traded on an exchange, because all we need to do is phone our broker, ask them to sell our assets, and a few days later the cash is in our account. So here we're looking at cash and short-term marketable securities over our current liabilities. Now, defensive interval ratio. What we're looking at there is essentially the majority of our current assets, so cash, receivables, marketable investments. Now again, notice what it's not including there, inventory, over the daily cash expenditure. What it's really looking at is, if no more cash was to come into the company, how long could we sustain our daily expenditure using our current assets? Now, cash conversion cycle. We talk about cash conversion cycles and cash operating cycle. Now, this is going to use some of the efficiency ratios that we calculated earlier. Notice we're looking at the days of inventory on hand plus the days of sales outstanding minus the days of payables. Now, what were each of those three terms? Days of inventory on hand, length of time between essentially receiving raw materials and selling finished goods. Days of sales outstanding, the time between selling a finished good and collecting the cash from the customer. Okay, now remember, these two together are the firm's operating cycle. But what we're then doing is deducting the number of days payable, i.e. how long it takes us to pay our suppliers. So what's the cash conversion cycle showing us? It's showing us the length of time between us paying our suppliers and receiving the cash from our customers. Now, for a lot of firms, of course, this figure is going to be negative. You have to pay your suppliers before you receive the cash from your customers. In which case, when we go back and analyze that current ratio, if you find essentially that you're paying your suppliers before you're receiving cash from your customers, then a current ratio less than 1 would certainly be an indication of liquidity problems. When we look at maybe supermarkets that have a current ratio less than 1, well, the days of inventory on hand are very, very low indeed. You go into a supermarket, the goods there haven't been sitting on the shelves that long. The days of sales outstanding, again, very, very short. But the days of payables, how long a supermarket will take to pay its suppliers, could be very long indeed. Why? They've got a lot of power over their suppliers, so they can delay payment. So in the case of a supermarket, it may actually use its cash conversion cycle as a form of financing other operations. And as a result, it can support a current ratio that's less than 1. So let's have a look at our cash conversion cycle. So our raw materials arrive, we start producing the good or service, and then finally we complete the good or service and sell those goods. Now that, of course, is our days of inventory on hand. Then we've got the length of time between selling those goods and collecting the cash from our customers, days sales outstanding. We've also got the length of time between our raw materials arriving and paying suppliers. Now that's the number of days of payables. So this length of time between paying a supplier and collecting the cash from the customer is the cash conversion cycle. Now, of course, if we pay the suppliers before collecting the cash from the customers, this means cash is leaving the business before it's received from customers. This can lead companies into overtrading issues. Let's imagine that you're a perfectly profitable company and you're expanding. But because you're paying your suppliers before you're receiving cash from your customers, what you might actually find is that your overdraft is expanding. And of course, it can lead to the situation when suddenly the bank withdraws your finance and the company collapses, even though it's perfectly profitable. So what we're really saying here is this cash conversion cycle will need to be financed. Now again, let's take the example of our supermarkets. Completely different scenario here. In that scenario, the cash is collected from the customer way before the suppliers are paid. In this scenario, therefore, this cash conversion cycle can be used to finance the firm. So if you pay your supplier before receiving cash from the customer, you need to finance the cash conversion cycle. Whereas if you pay the supplier after receiving the cash from the customer, then it's a source of finance for the company. So let's now move our attention towards solvency, and we're talking about, first of all, earnings variability, volatility of the company's earnings. Now, when we look at earnings volatility, in particular, we're looking at business risk and financial leverage. Let's start off with our business risk. Two components to our business risk: sales volatility and operating leverage. Now, sales volatility, of course, is simply the volatility of your sales over time, the variability of your sales over time. Operating leverage is the blend of fixed versus variable operating costs. Now, we typically say firms have higher operating leverage the more fixed costs they have. Now, the issue, of course, is fixed operating costs won't vary in line with sales. So as sales go up, that's going to be great. Your cost base remains relatively stable if it's fixed, giving you a much higher profit. But of course, the flip side is true. If your sales decline suddenly dramatically, your costs don't, giving you much bigger losses. So the greater the level of fixed costs, the more variable, the more volatile our operating profits will become. Whereas, of course, if you've got a firm that's purely variable cost base, well then as your sales vary, then of course your variable costs do too. So therefore, our operating profits and margins should be far more stable. Let's turn our attention to the other source of earnings variability, and that of course is our financial leverage. Now, operating leverage was fixed versus variable cost. Financial leverage is also looking at fixed costs as well, but these are the fixed costs introduced by your capital structure, whereas operating is looking at your fixed operational costs. Now, of course, as we lever up, as we introduce debt into our capital structure, we're introducing more fixed cost into the income statement. And of course, the fixed cost in the income statement is interest. Now, the other day, one of my candidates said, what happens if you issued variable rate debt? So in other words, you're paying variable interest, floating rate interest, maybe LIBOR-based interest. Now, surely that's floating, not a fixed cost. Now, the answer is no to that question. When we're talking about fixed and variable costs in relation to leverage, we're talking about a variable cost being anything that varies in line with your sales. Now, of course, floating rate notes, the interest payment normally varies in line with some benchmark, LIBOR-based typically, rather than your sales. So even variable-based debt, variable-based interest is deemed to be a fixed cost. So the idea is, as you lever up, as you introduce debt into the balance sheet, more fixed interest hits the income statement, and it's going to make your earnings even more volatile. So let's turn our attention to some solvency ratios themselves. Now, there's our definition of total debt, first of all. Notice total debt is interest-bearing short and long-term debt. So in other words, all of our interest-bearing liabilities. So we're going to ignore any liability that essentially does not have an interest component. So for example, trade payables typically are not interest-bearing. Now, our debt to total assets, total debt over total assets, I tend to think of this as being a little bit of a safety ratio. Typically, we want our assets to be greater than our debt because, of course, what we could do if needed is sell off our assets and use it to pay down our debt. So we typically want this ratio to be lower than 1. Now, let's look at debt to capital ratio. This is total debt over total debt plus stockholders' equity. Again, balance sheet values, of course, here. Now, total debt over debt plus equity, what we're therefore seeing is debt as a percentage of the capital structure. What proportion of your financing is coming from debt? Also worth noticing, of course, that these are pure balance sheet based ratios. We're looking at pure ratios, and therefore we can use year-end balances. Now, the debt to equity ratio, probably the most famous of them all, simply total debt over stockholders' equity. So we're just seeing proportions here of debt relative to equity. Financial leverage ratio, average total assets over average total equity. Now, again, you look at this and you think, well, why are we using average when it's a pure ratio? Largely because this forms part of our DuPont analysis. And DuPont analysis is looking at return on equity, which is net income over equity. So if we were looking at the financial leverage and it's sometimes referred to as the financial leverage multiplier. If we were just purely looking at it, we could just look at year-end total assets over year-end total equity. But in the DuPont scenario, which we're going to encounter a little bit later, then it's typical that we're going to use averages. Now we're looking at assets over equity here. Now the basic idea is if your assets were purely financed from equity, retained earnings, etc., then the ratio should be very close to 1. But as soon as we start to use debt finance to purchase assets, we're going to find that assets are going to increase, but equity will remain constant, and therefore the ratio will start to climb dramatically above 1. Now, within our solvency ratios, we also look at some safety ratios. And the first safety ratio, and one that's very, very common in the exam, is the interest coverage ratio. Here, we look at EBIT on our numerator and interest payments on our denominator. Again, it's a pure ratio. It's all coming from our income statement this time. So EBIT are earnings before interest and tax, divided by our interest payments. And it's a safety ratio because it's looking at how comfortably we're meeting our interest payments out of our profits before interest, EBIT, essentially. Again, idea here, the bigger the ratio, the safer those interest payments are. Interest coverage, therefore, commonly built into debt covenants. Fixed charge coverage looks at all of your fixed charges other than just interest. So we take EBIT and we add back any operating lease payments to that, and we then look at interest payments plus lease payments on our denominator. So it's a little bit beyond interest coverage. It's looking not only at interest coverage, but lease payments as well, how comfortably we're satisfying those payments. The reason we're adding back lease payments on our numerator is because they would have been deducted in arriving at EBIT, so we need to add them back, if you like, to get an operating profit before lease payments on our numerator. Right, let's turn our attention now to profitability ratios. Our profitability ratios are really focusing largely on the income statement. Now, our first set of profitability ratios here, the first one we see is the gross profit margin. Now, gross profit margin is gross profit over sales. Again, it's a pure ratio. Gross profit being simply sales less our cost of goods sold. So we're looking at our gross profit as a percentage of sales. How efficient are we at converting our sales into profit? Now, operating profit margin looks at our operating income over our sales. Now, what is our operating income? Well, typically, we're going to use EBIT as an approximation. But again, that is a rough approximation because EBIT is going to contain non-operating items such as dividends received, gains and losses on investment securities. All it's really excluding is interest, tax, and maybe some of our extraordinary and discontinued operations. So be a little bit careful. EBIT is really only a proxy to operating income. But again, it's looking at how this ratio is looking at how we convert our sales into operating profit. Pre-tax margin, so this is our earnings before tax but after interest, sometimes simply referred to as EBT, earnings before tax, over our sales figure. Yeah, I'm not exactly that excited by that margin, but net profit margin, of course, very important. Net income over sales. Now, net income is often referred to as being the bottom line. So this is looking at how we're converting our sales into bottom line profitability. Now again, notice most of the return on sales profitability ratios would be on the face of a common size income statement. Notice our denominator all the time is revenue. So of course, by definition, when we calculate the common size statement, net income over sales is the net profit margin. If we've got a multi-step income statement and we're showing gross profit divided by sales is the gross profit margin. So a lot of our profitability ratios would be shown on the face of common size statements. Let's look at a few other ones, profitability ratios. Now, what we're turning our attention now is to some mixed ratios. The first one we've got here is our return on assets. Now, we're looking at net income on our numerator and average total assets on our denominator. Mixed ratio, so notice we're using that average. Now, I have a bit of an issue with this because we know from our balance sheet equation that essentially assets equals liabilities plus equity. So in other words, if we're using assets on our denominator, that's the same as saying you've got liabilities plus equity. In other words, you're looking at both debt and equity on the denominator, but of course net income is after interest payments. So we've got debt and equity on our denominator essentially here, but a post-levered measure of earnings on our numerator. So it's a little bit odd really. Net income only belongs to the shareholders. Now, that does lead us therefore to an alternative version that actually corrects for this problem. Notice now on our numerator we're including not only our net income but also the interest expense net of tax. So what we're trying to do is look at net income essentially after tax but before interest payments. So we're including on our numerator the returns for the shareholders, net income, but also the returns to the debt holders, the interest expense net of its tax on the numerator. And that kind of makes more sense to me. Now that does lead to the question, if the examiner says calculate return on assets, which one should you use? I have to say probably more traditionally is the first calculation. So if I was told return on assets in the exam, I would use net income over average total assets. Operating return on assets, notice that's our operating income over average total assets. Again, classically we would probably use EBIT as a proxy for our operating income. So what is return on assets actually really showing us? It's showing us how we use our asset base to generate bottom line profit. So it's all about not only profitability but also the efficiency with which we use our assets. Some other profitability ratios, return on total capital. Now notice we've got EBIT. Now EBIT of course is pre-levered. And when we say pre-levered, we just mean before any distributions to the debt holders. So it's before interest payments, so we like that. And look, we're just simply looking at debt compared to debt plus equity on our numerator. I have no problems with this. We've got a pre-levered measure of earnings on our numerator and we've got debt and equity on our denominator. Seems to make perfect sense to me. Only slight criticism I would have with return on total capital is it's also before tax. And of course tax needs to be paid before any distributions can be made to shareholders. I think maybe an even better measure that we could look at would be to replace EBIT maybe with NOPAT, net operating profit less adjusted tax. Now very basically we can say that NOPAT is equal to our EBIT times 1 minus tax. So this essentially would be profit before interest payments but after tax payments. Return on equity, well here is our very, very classic ratio, often used to appraise management performance, looking at the stockholders' equity compared to net income. So net income on our numerator, average total stockholders' equity on our denominator. How are they using the funds that the shareholders have invested in the company? How are they using those to generate profitability for the company? So an absolute critical one to take into the exam. I'm going to go as far as saying it will be in your exam. A lot of these ratios will be in your exam. You really do need to master these. You're going to see tons of ratios. Remember, when they're looking at accounting treatment, so maybe we're comparing percentage of completion to a completed contract, for example. Now again, the examiner is very likely to test that by how does this affect your profit margins, for example. So we always need to be strong on our ratio analysis. We'll see a lot of questions. Return on common equity, well this is just taking into account preferred stock if we have it. So look, we're looking at net income minus any preferred dividends on our numerator, i.e. profit attributable to our common stockholders, and we're looking at average common equity on our denominator. Now the average common equity here on our denominator is simply going to be your stockholders' equity with any irredeemable preferred stock removed. Now our next LOS asks us to describe relationships among ratios and essentially analyze or evaluate a company using ratio analysis. Now I think it's going to be very difficult to analyze a whole company using ratio analysis when we're looking at a multiple choice exam. where each question is standalone and we've got 1.5 minutes per question. But I certainly think we might be looking at a little bit at how ratios are interact. So let's have a little look at an example. We talked about this earlier as being a limitation. You can't really view ratios in isolation. If one ratio is changing, we need to consider how other ratios are changing and look at the overall combined picture. In other words, we've got to analyze ratios collectively rather than individually. Now, as we said, use information from one ratio category to answer questions raised by another ratio. Now, a classic example of this, and it's one of the examiner's very favorite kind of types of question, or it certainly was frequently examined years ago. These days, of course, people are not allowed to say the contents of the exam. That wasn't the case in maybe years gone by, and it's certainly an area that was examined heavily. So I would say, I'm guessing the examiner still tests it heavily. I think DuPont is one that you need to be strong on for your exam. Okay, before we look at DuPont, let's just talk about maybe an approach to looking at these integrated financial ratios. So what have we got here? The current ratio, current assets divided by current liabilities. The quick ratio, very similar, but remember it's our current assets excluding inventory. We've then got the days of inventory on hand and the days of sales outstanding. First of all, let's make sure we've got the columns in the right order. So of course, XA is the newest and X6 the oldest. Okay. So let's have a look at the current ratio. The current ratio, you can see overall, has been increasing. It's gone from 1.2 to 2. Now remember, what that's telling you is current assets as a relative to current liabilities are increasing. So our current assets are increasing relative to current liabilities. Now when we look at the quick ratio, notice in X6 it was 1, X7.8, X8.5. Interesting. So when we look at this, essentially the quick ratio is falling over time. Now remember, this is our current assets excluding inventory over current liabilities. Now what is this telling us? If the current ratio is increasing, but the quick ratio is decreasing, it must be due to inventory. That's the only differences between them. And because the current ratio is going up, that is telling us this company must be building up relatively its inventory levels. So we know proportionally we've got increases in inventory here. Let's see what days of inventory on hand are telling us as well. Well, we had 30 days of inventory on hand back in X6, rising to 50, rising to 60. Another good indication. It seems like this company is definitely carrying more inventory. We've got an increase in the days of inventory on hand. Now at the same time, days sales outstanding, we were taking 40 days to collect cash from our customers. We're now only taking 20 days. So we're either far more efficient in collecting cash from our customers. Well, that's essentially what we are. We're much more efficient collecting cash from customers, and it looks very much like this cash, we're accelerating the receipt of cash from customers and using it to stockpile our inventory. Now that could be because we think that sales are going to be higher in the future and therefore we're building up our inventory levels ahead of demand, but it could be an indication of inefficiency. Well, let's have a look. So the current ratio is up, the quick ratio is down. Why? Well, we said the answer to that was inventory levels. Okay, so yeah, rising inventory. Days of sales outstanding, of course, has decreased, indicating we're collecting cash from customers. Current and quick ratios indicate the collected cash is being spent on inventory accumulation. So just as we said on the previous slide, it looks like they're collecting cash quicker and they're building up their inventory levels. Now conclusion, they've concluded here that collections have been accelerated to make up for poor inventory management. Again, I think this conclusion that we've got poor inventory management is a bit of a leap just by looking at the ratio. It's one potential answer to why the ratios have changed this way. But as I said, it could be that they're building up their inventory levels ahead of higher anticipated demand. Now, here is our DuPont analysis. Very, very important that you get to grips with our DuPont. We need to demonstrate, calculate, and interpret DuPont. Now, DuPont, you might have thought DuPont in the past as the company that developed nylon. Now, from this point onwards, you're going to think of these hideous ratios. They're going to be with us at level 1. They're going to be with us at level 2. They're going to be with us at level 3. We're never going to shake the DuPont. Really, really critical that we get a good grip on this in our exam. So ROE, net income over equity. Now again, notice it's a mixed ratio. So really we should be saying average equity. We should be using average balance sheet values. Now we said what ROE is. It's showing us how the managers of the firm are using the funds under management. Remember, equity is equal to assets minus liabilities. So it's really showing us how the net assets of the firm are being used to generate bottom line profits. Now notice if ROE has changed, we might want to get a bit more data. Why has it changed year to year? So we can split our ROE into two further ratios. We can look at net income over total assets, which of course is our return on assets. Again, it's a mixed ratio, so this would really be average total assets and total assets over equity. Now again, that's of course a pure ratio, total assets over equity, but because overall we're looking at a mixed ratio, we should still really be using averages here. Now notice essentially if you multiply these two ratios together, return on assets and the financial leverage multiplier, then essentially your total assets would cancel and you're left with net income over equity. So the ability now is if ROE has changed, we can now say, is it because of the efficiency of which we're using our asset base to convert, using our asset base to generate profits, i.e. is it an issue with return on assets, or is it because our leverage has changed? Now notice as leverage increases, as the financial leverage rate multiplier increases, goes up, then our ROE is going to rise in this case. Now, DuPont, the original equation, this is our three-stage DuPont. So again, we're going to take our net income over equity and split it into two further ratios. We're going to look at net income over revenue, net income over sales if you like. Now net income over sales, of course, is the net profit margin. So we're looking at net profit margin times revenue over equity. Now this ratio would be referred to as equity turnover. What is equity turnover? The efficiency with which we use our equity or convert our equity into actual sales. Now, significance of this is we can take our equity turnover and we can split it into two further ratios. Now, notice what we're going to do is we're going to look at asset turnover, revenue over total assets, and assets over equity, the financial leverage multiplier. So now we've got a real good handle maybe on why ROE has changed. We're saying if ROE has changed, is it because our net profit margins have changed? Is it because our asset turnover has changed, i.e. we're more efficient in using our asset base to generate sales? Or is it because the leverage of the company, the level of debt, has changed? So it's really starting to allow us to analyze changes in ROE over time. Now again, remember this is a mixed ratio, so all of these balance sheet items here, we've been a bit naughty here. We should really be saying average, average, average. Now, the extended equation. Not only do we have 3-stage DuPont, but we actually have 5-stage DuPont. Just flicking back to the previous slide, you can see we haven't got much data on our margins. We're just looking at the net profit margin. But why? If this has changed, we might want to know why has the net profit margin changed? And that's what 5-stage DuPont looks at. So notice it's taking our net profit margin and it's splitting it into essentially 3 further ratios. It's going to split it into EBIT over revenue, operating profit margin or EBIT margin. Again, remember operating profits and EBIT not quite the same, although we tend to use it as a proxy. So EBIT over revenue, how efficient are we at converting sales into operating profits? The next one we look at is earnings before tax over EBIT. Now again, the way I used to remember this, because I know it's difficult to remember this at first, it's strange. I remember doing my level 1 CFA exam and thinking, I'm never going to remember these DuPont equations. And now I've seen them so many times whilst I was doing my studies, I can't shake them out of my head. They're just ingrained there forever. Now, notice what's happening here. Whatever is on your numerator becomes the denominator for the next equation. And that's a little trick to remember it. So the next one is looking at earnings before tax over EBIT. Now, of course, this is referred to as the interest burden because that's essentially the difference between those two figures. So if interest goes up, we'd expect this ratio to be affected. We'd expect the denominator to be essentially unaffected, but the numerator to be smaller. Now notice then, our earnings before tax becomes the denominator for the next ratio, and net income the numerator. Now of course net income is really earnings after tax. So they refer to this ratio as the tax burden. Now again, I think that's a little bit of a misnomer because of course there are other items than tax between earnings before tax and net income. Yes, we see the tax expense, but remember discontinued operations and of course our extraordinary items also pass through. If we actually have associates, affiliates as well, any earnings from those or our share of the earnings from the affiliates also pass through. So, you know, I don't think it's an issue for the level 1 exam, but it is a little bit more of an issue when we get through to level 2. Just be aware, whilst we call it the tax burden, the difference between net income and earnings before tax in practice isn't just likely to be the tax expense. Now the key with our 5-stage DuPont is now if our net profit margin has changed, we can say, well look, is it as a result of operating margins? Is it a result of a greater interest burden, which of course should be linked to financial leverage, or is it because we're paying more or less tax on a relative basis? So operating profit margin times interest burden times tax burden. Well, if we multiply those 3 together, then of course we've got the net profit margin times the asset turnover times the financial leverage multiplier. And notice we're telling you here that the tax burden is 1 minus the effective tax rate of the company. This is essentially simply the company's tax expense in the income statement, sometimes referred to as a tax provision, over the earnings before tax. That is the effective tax rate for a company. Now we turn our attention again to a new LOS that says calculate and interpret ratios used in equity and credit analysis. And we're going to see these as well in other areas of the syllabus. So probably the most famous ratio of all is the price earnings ratio. Stock price divided by earnings per share. What is this showing us? Well, it's showing us how many times, what multiple of earnings investors are willing to pay to acquire equity. So there's two real things driving our EPS. Certainly earnings growth are going to drive EPS. The higher earnings growth is likely to be in the future, the greater the multiple of current earnings I'm likely to pay, but it also reflects risk as well. Greater risk, a lower multiple. So we're seeing our PE ratio, very, very important. Price to sales, this looks at stock price as a multiple of sales per share. Quite useful maybe if you're looking at a company that doesn't have any earnings, so an unprofitable company. Now, of course, if you've got an unprofitable company, the problem with the PE ratio is essentially you get a negative figure, which doesn't make any sense intuitively. The benefit of price to sales, of course, is sales are always going to be positive even if earnings are negative. Downside of price to sales is it doesn't really look at the cost structures of the company. Essentially, when you do buy a stock, you're buying the entitlement to future earnings, not the entitlement to future sales. Now, price to cash flow, stock price scaled by some measure of cash flow per share. We could maybe use cash flow from operations as a measure here, or cash flow from operations per share. Probably the most theoretically sound would be to use free cash flow to our equity holders. Beauty with cash flow is it is maybe more difficult to distort, more difficult to manipulate than earnings figures are. Now, price to book value, stock price compared to the book value per share. Book value per share, balance sheet value of equity divided by the number of shares outstanding. Now, this is a key multiple. In the studies of Farmer and French, they found that choosing companies with low price to book values outperformed almost every other relative valuation technique that they tested. So price to book value per share, a key one. Per share quantities, well, again, basic EPS and diluted EPS, we've seen these already. They're back in our earlier readings where we actually have to calculate basic EPS and diluted EPS. So again, here's our examiner saying, look, not only can I test it in earlier readings, but I can test it here. Know how to calculate your earnings per share figures. Know, of course, when you calculate diluted EPS, it's making an assumption that any dilutive securities are converted into common stock at the beginning of this year, regardless of whether they can in practice. And again, remember, we ignore any anti-dilutive securities. Cash flow per share, CFO divided by the weighted average number of shares. Well, it's a bit like, of course, our basic EPS, but this, of course, is using a cash-based measure rather than the earnings attributable to common stockholders. EBITDA per share. EBITDA per share, I have issues with this. I like the fact that it's before depreciation and amortization. And let me just quickly define EBITDA. Earnings before interest, tax, depreciation and amortization. Now, I certainly like that it's before depreciation and amortization because those are non-cash items. So, in other words, EBITDA is closer to cash than EBIT is, and I like that. Also, depreciation and amortization are two of the most volatile items over time, so you tend to find that EBITDA will be more stable over time than EBIT would be. So it's certainly got some advantages. I'm not that keen that it's before tax, because of course tax has to be paid before distributions to shareholders, and I'm really not that keen that it's before interest. So in other words, EBITDA is a pre-levered measure of earnings. It's available to both debt and equity holders, but really we've got the average number of ordinary shares on our denominator. Really, if I was looking at EBITDA, I would like to look at it as a multiple to enterprise value, which essentially is the book value of both your debt and equity. A little bit more complicated than that, but that will do as a definition here. Dividend per share, simply the dividend, total dividend paid divided by the total number of shares outstanding. No real tricks to that one at all. Dividend payout ratio. Now this one's going to be important And again, we're going to see this coming up all throughout the CFA syllabus at multiple levels. So notice we're looking at the common dividend over the earnings available to common shares. Now, the earnings available to common shares, of course, are the total profits that could be distributed this year to our shareholders, the common dividend being the actual dividend. So we're looking, when we look at the dividend payout ratio, what percentage of earnings were paid out to the common stockholders. Now, that is inherently linked to the retention rate. If you discover that 40% of your earnings are paid out by way of a dividend, then it implies, by definition, 60% of your earnings are retained within the business. So notice, all we're doing here is we're taking our earnings available to the common stockholders, in other words, net income minus preference dividend on our numerator, and then subtracting the common dividend. So this is essentially the profits that are reinvested in the company, and we're dividing that by the earnings available to the common shareholders. So the proportion of the earnings that are reinvested. Sustainable growth rate. Now, we talk about it here as being the sustainable growth rate in earnings. Later on in equity, we talk about it being the sustainable growth rate in dividends. Now, the two will be the same if you have a constant payout ratio. So if we always pay, let's say, 10% of our earnings by way of dividends, then by default, earnings and dividends must grow at the same rate. So let's have a look at our sustainable growth rate. It's equal to the retention rate times ROE. The argument is here, why are we going to see growth? We're going to see growth because we reinvest profits within the company, and those reinvested profits generate the return on equity. Now, be careful in interpreting the sustainable growth rate. I've had a lot of students over the years claiming that this is the growth in earnings that the company, or growth in dividends that the company can sustain without raising any external finance. You've got to be a little bit careful. Actually, the sustainable growth rate is the rate of earnings growth that can be sustained without raising any external equity finance, but keeping the financial leverage multiplier, or keeping the debt to equity ratio leverage constant. Now, idea therefore is it's not precluding us raising new debt. Now, again, if we're profitable, as earnings go up over time, if we weren't going to raise any additional debt, leverage would come down. So actually, the sustainable growth rate is the rate of earnings growth that we can sustain, essentially by using reinvested profits for any equity portions of capital budgets, but keeping our leverage ratio constant. And that's the bit that people miss. It's all about keeping the leverage ratio constant, as well as using reinvested earnings for your growth. Very, very common ratio to have to calculate. You're going to see it here in accounting, but it's going to come up all over equity valuation. Business risk ratios, I think I'm a little less excited by these. Notice we're looking at coefficient of variation here. Now, coefficient of variation you've encountered in the quants material, standard deviation divided by mean. Mistake I see a lot of people making is wanting to do mean divided by standard deviation, and I think that's because they're thinking of things like the Sharpe ratio, where you're looking at excess return per unit of risk. Here, we're looking at risk per unit of return. So standard deviation divided by mean in each case. Notice the coefficient of variation in our operating income is a measure of volatility of your operating income. Standard deviation, of course, is an absolute measure, and therefore we're converting it into a relative measure by dividing through by mean. So standard deviation of EBIT over mean EBIT, coefficient variation of net income, standard deviation of net income over mean net income, and coefficient of variation of revenue, standard deviation of sales over mean sales. And again, lower volatility is better, so essentially the lower these ratios are, the less volatility we're witnessing. Using ratios for equity analysis. Now again, well look, when we look at this, it says, well look, here are some ratios that are useful in equity analysis, in forecasting earnings, stock returns, etc. And it then goes on to list virtually every ratio that we've encountered so far. So unless you've got a lot of time on your plate, I wouldn't suggest that you attempt to rote learn these. Just be aware that ratio analysis is absolutely a linchpin of equity analysis. Credit ratings and ratios. Well, of course, when we're looking at credit ratings, we're looking at our rating agencies, Moody's, Standard & Poor's, Fitch's. Certainly they're going to be interested in calculating ratios. Interest coverage ratio is going to be a key one. How safely you're meeting your interest obligations. Remember our interest coverage ratio, EBIT over the interest payable expense. Return on capital. Now, of course, our return on capital, we could look at it as EBIT over debt plus equity. Debt to asset ratios, total debt over total assets. And of course, other measures are going to be important here. It's not just debt to assets, debt to equity, or debt to debt plus equity. Of course, the proportion of debt in your capital structure are going to be critical as well. What we find, of course, is as we leverage up more and more, introduce more and more debt, the risk to debt holders goes up, bankruptcy risk increases, and of course that will affect our affect our credit ratings. Sorry. Now again, our rating agencies typically are going to make adjustments before they calculate these ratios. And we said, look, they all make adjustments for off-balance sheet debt. The classic one of those is operating leases. Now, an operating lease, and we're going to see it in later readings in a lot of detail, operating leases, you're renting in an asset, you're using it in your business operations, but no asset appears in the balance sheet, no liability appears in the balance sheet. Now, we've certainly got an issue there with no liability appearing because we've got an obligation to make periodic rental payments. So we've got a commitment to make future outflows, but no liability is showing up. So the treatment of operating leases remains very, very controversial. You know, the treatment of operating leases has been controversial for at least the last 20 years. I remember when I was an auditor, an accountant, and this was back when I first graduated from university, and you can tell just by looking at me that was some time ago now. It was an argument that essentially operating leases should be removed and essentially an asset should be created and a liability created for all leases, regardless of whether they're operating or capital leases. And that was 20 years ago, and we're still in the situation where it's being debated ongoing. There's a great quote by David Tweedy, the chairman or the ex-chairman of the International Accounting Standards Board. And one thing, his quote says, "Before I die, I want to look at a set of airlines accounts and see aircraft in the balance sheet." Why don't they? Well, of course, airlines tend to hold the aircraft under operating leases. So no asset, no liability. Means, of course, when you look at the leverage ratios of an airline, unless you capitalize those operating leases, you get massive distortions. Segmental reporting. We talked about this very briefly early, but now it's time to dip into the detail. We're asked to explain the requirements when you have to segmentally report. We're asked to calculate segmental ratios and interpret what they mean. So remember, we're going back to this idea that You've got a conglomerate, a company that's made up of lots of diverse business operations. And the problem that their income statement, their balance sheet and their cash flow statement is amalgamating, aggregating all those different business activities, meaning it is very difficult to undertake cross-sectional comparisons. You would need to find a company with the same business activities in the same proportions, virtually impossible. Now, the good news is segmental reporting will certainly, to an extent, solve some of our problems. Now notice, we have a reportable business or geographical segment. So not only do you need to report by divisions, but potentially you need to report geographically as well. If 50% of its revenues are from external sales, and it comprises of at least 10% of the firm's revenues. Now, look, this first point, external sales, all this is simply saying is, look, if you had a division and all of its sales were internal, i.e. into other group companies, then potentially it wouldn't need to be disclosed. I don't think that's a big point. I think the point that you really need to take in is you've got a reportable segment if it comprises either of 10% of the firm's revenue, 10% of the firm's earnings, and we typically look at EBIT when we're looking at that, or 10% of the firm's assets. Okay, and it's any of those. Doesn't have to be all of those. If it's 10% of revenue, earnings, or assets, then it needs separate segmental disclosure. Now, once we've got a segment, what do we actually need to disclose? We need to show revenues, and those revenues need to be split into group, i.e. internal and external to third parties, operating profit, and of course we'll use our proxy for that, EBIT, assets, liabilities, but notice with our liabilities it's IFRS only, not US GAAP. Now what that's actually therefore going to imply is we're going to be able to calculate leverage ratios under IFRS on a segmental basis, on a divisional basis, but we're not going to be able to do that under US GAAP. CapEx needs to be disclosed segmentally. That's going to be useful because that's going to allow our analysts to look at which divisions are being invested in and which aren't. Depreciation and amortization as well is separately shown. So let's have a look at some of our key ratios that we might be asked to calculate in the level 1 exam. Segment margin. Well, this is simply the segment profit. Remember, we're going to be using EBIT for that over segment sales. So it's an operating profit margin. Segment return on asset, again, segment profit, we'll have to use EBIT here over segment share of assets, the assets used by that segment. So again, remember, return on assets, looking at how we're using the infrastructure of this division to generate profits. Segment asset turnover, so segment sales over segment assets. Well, again, remember, asset turnover is an efficiency ratio, looking at how efficient you are at using the infrastructure of the company to generate sales. And notice the segment debt ratio were IFRS only, segment liabilities over segment assets. Okay, so again, a leverage ratio. Now, our very last learning outcome in this particular reading is to describe how ratio analysis can be used for modelling earnings. Now, key point here is we're looking at common size statements to do this. Now remember, in particular, common size statements, the ones we've encountered in the income statement, every item within that income statement was shown as a percentage of sales. Now, if those percentages are relatively stable over time, so in other words, we need a company that is largely variable cost based and its market is relatively stable, then we could take the figures from the common size statement to forecast future earnings. How could we do that? Well, first of all, we look at the expected relationships amongst the financial statement data, i.e. we calculate the percentage common size balances. Okay, then essentially we're likely to be using an earnings-driven model or a revenue-driven model. Now with revenue-driven models, and I think that's the focus here, what we then do is we forecast future sales apply them to those common size balances to get our future earnings. Earnings or our forecast of earnings. Now, sensitivity analysis just means stress testing our model to some degree, looking at how sensitive our output is to any of the inputs into our model. Scenario analysis, typically we run best case, average case, worst case scenarios. And simulation, now the classic simulation of course is Monte Carlo simulation, where we look at each input into our model as a normal distribution with a standard deviation, and we select random values. Plug them into our model, repeat the process thousands of times to get a distribution of all possible outcomes.